Welcome everybody to this month's edition of our business cycle chart book. This is Axel Merk, President and Chief Investment Officer of Merk Investments. And of course, the context this time around is that everything was going fantastically last year in the US. And then towards the end of the year, the markets had a tantrum suggesting that maybe this expansion is long in the tooth. Are we about to fall off a cliff into recession? And the reason this is all relevant is that historically the markets have done far worse during recessions than during economic expansions. And indeed, it's rare to have a bear market when there isn't a recession. In '87, we obviously had a crash. They had a very short-term adjustment from which we rebounded. A theory, I'm not saying that this will always be the case, is that yes, we can have these crashes or even slow motion crash, if you want to call it as such, the correction we had up to the beginning of the year. But question is this economic expansion intact? And if you've been listening to what I've been arguing, is that I've said that, sure, we are late in the economic cycle, but we're not there yet. And some of that I think we'll see confirmed here. We focus on the business cycle here, but one of the things I've pointed out is that the positioning in the market was for much higher rates at the end of third quarter. And as there was a repositioning taking place, call it short squeeze or whatever, there was a rally in treasuries, and that took on a life of its own, and people, quote unquote, freaking out. Now, all that said, yes, there is a trade war maybe happening. There are clear signs of slower economic growth elsewhere in the world, and you add up some of these trickles, and suddenly you got a recession potentially. Leading economic indicators here are weaker, but they are in expansionary territory. Now, one thing to keep in mind is it is quite possible and feasible that one, quote unquote, falls off a cliff. That has happened in the past. It is possible that everything does look hunky-dory and then suddenly it doesn't anymore. Let's look at this yield curve steepness. A lot had been made of the inversion of the yield curve, meaning that shorter rates might move above longer rates. That has not happened. Part of it may well be that there has been so much attention to it that it spooked some folks at the Fed as well, and so part of the reason they may have paused. But of course, one thing that may happen is, just like with many other news, there's so much focus on it that then things don't happen, and when it does eventually happen, that it's not covered quite as much anymore. And so I still think there may well be a yield curve inversion coming on the backdrop of higher rates. And again, I've mentioned this in the past, the reason why rates are hiked, of course, is because there are some potential excesses in the economy that the Fed needs to stem against. And the one I'm most concerned about is rising wage pressures. This view is not shared at the Fed, at least not by Mr. Powell. He thinks higher productivity will take care of things. Anyway, purchasing manager indices, we had a dip down, a little bit recovery, but if you put this in a global context, clearly there are some places in the world where things are a bit of concern. China is below that 50 metric. Now, keep in mind, some people are saying, hey, you have this razor-thin line, and why the heck should 49.9 be contraction at the end of the world and 50.1 be great? And that's, of course, a fair criticism. That said, part of the reasons we show you this spaghetti chart here is to show you what's happening around the world, right? I mean, yeah, 1 below is nothing, 2 is a little bit more, and then suddenly you get more and more, and yeah, with hindsight, will tell you I told you so. And that's only partially useful because, of course, you want to make an investment decision looking forward rather than looking backward. At the same time, the data is what it is. And so we have to look at that. My view has always been it is a question of risk assessment. It's impossible to be absolutely perfect, precisely saying when there's a recession. And as you saw in recent months, let's now assume for a moment we'll hit a recession in the very near future. Well, yes, then you'll say, hey, maybe the market was ready, was early, and showed the decline late last year. Now, that said, I don't think so. We had this tantrum in the markets that spooked the Fed, but you've seen a recovery in the market. And a lot of that is because we're just not there yet with regard to recession. Job gains are rather dramatic, rather tremendous, very large job gains, and unemployment momentum. Here you see one critical point we are watching, the U3 rate, the unemployment rate, the officially stated unemployment rate breaking through the long-term moving average. Now that could be negative. Nick here in the blue comment areas I mention always is those written by Nick. He points out if the labor participation rate was also trending lower, would be a clear negative. Agree to that. Now, the one thing to keep in mind with this data point, though, is that this was during the shutdown. The U6 rate soared. Now, don't want to get too technical, but basically the folks who would love to work more, who are forced to work less, that number surged. And overall, it's been said that the shutdown has had fairly limited impact, but also keep in mind that some of the folks filing for unemployment claims, some people checked the wrong boxes or answered questions not exactly the way you would have otherwise. And so I would suggest that this number might be an aberration a little bit. Now, all that said, you cannot go to 0 and below 0. So at some point, we have to break through the moving average. And so we just should take it as it is. But there is an explanation here that does not necessarily mean this economy is kind of falling off a cliff. Capacity utilization based on a model by the Congressional Budget Office is above what is long-term sustainable, but I mean, yes, it's worth looking at, but I don't put too much emphasis on this, as you can see, when this matters when it falls off a cliff, right? Same with the output gap. Those are models. Atlanta GDP Now forecast has been reasonably good. Now, I am not sufficient of an expert on it to know how exactly that forecast is distorted by the shutdown. And some people have said we'll have lower GDP growth. Again, if we have very low GDP growth for the current quarter, the shutdown has a big influence on that. And so while, yes, the numbers may be lower, I mentioned sometimes forecasting GDP to the second decimal is not going to get you wealthy, meaning that that's not good for an investment decision. Here, this is one reference point as to where things go, and this particular metric shows we're not falling off a cliff. Credit cycle, that is probably one of the key reasons why I continue to be optimistic about this economic cycle. Consumers are doing just fine. Thank you very much. Again, sure, delinquency might spike because of the shutdown. If you think about it, you have people who are not getting a paycheck, and a portion of those might have been on the edge to being delinquent, and that may well have pushed them across the edge. So the shutdown itself might have pushed some people across that edge, and so that's a bit of a pity, because it's not just that it's very, of course, tough for the people affected by it, but a pity in the sense of assessing where we are in the economic cycle, because again, that could be shrugged off as a temporary move. Consumer confidence, that is something to be watched. Draghi in the Eurozone downgraded economic the risks to the forecast. It's because it's not like all these risks are going to be necessarily detrimental. Draghi, even in Europe, said, hey, we can deal with Brexit. In the US, Powell mentioned now Brexit as a risk that concerns him. I think he's trying to justify his action. The UK is less than 3% of global GDP. That's not going to make or break the US economy. The trade that comes from the UK with it. But if the overall sentiment gets affected, that of course can lead to less consumer spending. And in the US, of course, an overwhelming part of the economy is related to consumer spending. So it is consumer confidence is very important. And it's part of but at the same time, it is possible to steer that a little bit. You can engineer good news on trade, right? Especially with a commander-in-chief that can turn on a dime on many things. But this is something to be watched. This is something I would give very significant importance. Lending standards, very important. People talk about financial conditions. Financial conditions is not the stock market. If you were Greenspan, maybe, and I'm not suggesting Greenspan only looked at the stock market, but the wealth effect was emphasized quite a bit in the Greenspan years. Powell hasn't referenced that as much. Now, obviously, as we've seen in recent history, Powell gets affected by it, but this is really what matters, this chart. And I'm not saying this is the best thing since sliced bread, but it matters whether credit is accessible. And this is one of the metrics the Fed historically has watched. Obviously, you can look at junk bond yields and whatnot as well. They have gotten elevated and not quite come back to the pre-volatile levels. But keep in mind also that the whole point of raising rates is to tighten credit conditions. And so it has, while it has reached kind of the outskirts, emerging markets, maybe high yield, it hasn't reached the area where it matters. And yet the Fed is still has the foot on the accelerator, according to many, many metrics. We are only at the edge of what may be considered neutral. So in this context, I do think if the glass continues to be half full, or will be half full again, depending on where you are on this, I would not be surprised to see one, or I would think even 2 rate hikes this year. So here we have the high yield spreads. They can't come down, but they're still a little higher. So, and those things then tend to move a little bit higher. So yes, we are towards the end of this economic expansion, but near the end may still mean 3 months, 6 months, 9 months, 12 months, 18 months, 24 months, and or even longer, according to some, right? So I wouldn't prejudge this, and see how this works and goes along. Here, building permits have come down a little bit, and obviously, if you were furloughed, you probably had a more difficult time qualifying for a mortgage as rates had come down. But yes, the higher rates starting to have a bite. I've mentioned before, housing market is half as important as it was in 2007, but it doesn't mean it's not important. So this is Nick's summary here of his assessment. And in the short term, neutral with / positive high uncertainty. I subscribe to that. I do happen to think that, yes, this economic expansion is firmly in place. Please download the chart book, the PDF, if you haven't already, to study these comments in more detail. China is really the elephant in the room. Germany might get a recession, a technical recession, I would call it. That's because things are good in Germany in general, but ultimately consumer confidence is what I would emphasize as well. And please always read the disclosure. So with that, give us feedback, what you like and don't like about these chart books. Tell your friends about it. And this year is obviously behind the paywall. Tell your friends it's worth subscribing to it. Thank you, and talk to you soon.